Good evening, everybody. Happy Sunday. It's June the 26th, and the markets last week were unsurprisingly positive. Let's see if the markets can continue to sustain that and for how long. I'm your wealth guy. Let's talk money. Let's talk Sunday night market preview. All right, everybody. So I'm going to jump right into it. I'm going to try to keep this one short. A couple of my videos and takes have taken far too long, so let's try to keep this one tight. But first, thank you very much for tuning into the channel. I really hope you like what I have to say today. If so, please don't hesitate. And even if you don't, share, like, subscribe, and most importantly, comment, because I really want to hear what you have to say about the markets, where they're going, and your thoughts on interest rates and the actions of the central banks. So last week, the markets continued to move to the upside. It was actually quite significant, where the markets essentially, especially if you take a look at the S&P 500, are no longer in bear territory, have actually inched their way back into correction territory, which is less than a 20% loss or dip from the highs, which is exactly where we are now. Even today, the markets have already opened, the futures market, and the S&P 500 or the US 500 is currently at 3907, whereas we were closer to 3850 as far as the bear market numbers are. I think it's a bit lower than that, but you catch what I'm saying. Now, how did this happen? Why did it happen after the interest rate increase of 75 basis points? And where do we go from here? Well, I talked about this a little bit last week with the European Central Bank calling for an emergency meeting in which they had to deploy tools to help prevent fragmentation, if I'm not mistaken was the correct word, of the debt market, which essentially meant that they had to prevent the collapse of the debt market, which would have caused the collapse of the equities market. And I focused a little bit on that last week, but I feel it's important that we focus on it again this week, because the impact of what that's going to do to the markets and to the economies in general will be quite significant. So not only did we see the European Central Bank do that, but in fact, if we take a look at the books of the U.S. Fed, we'll see that they printed another $20 or $30 billion last month. So the printing press hasn't stopped, contrary to what they're saying. It's not quantitative tightening. In fact, it's now emergency tools and money printing, or essentially it means money printing. Now, it's going to cause a big problem, because in itself, it is massively inflationary. So these little cute 75 basis point increase, which are really going to do nothing for fighting inflation, are going to be absolutely, I guess the best word to say is useless. When you're printing enough money to buoy the entire global debt market, and it's not one central bank, obviously, not just the European central bankers, it's every central bank will have to follow suit. Because what we saw prior to the interest rates was, and I believe just after as well, we saw a massive spike daily. Every day, 5%, 5%, 6%, 7% increases. And I believe at one point we saw an 8% increase, 8.65, I think, was the increase in that intraday move for the U.S. 10-year yield. Frightening numbers. We were literally on the cliff of a total equity collapse as a result of a debt market collapse. And so that's why emergency tools were deployed. That's why money printing continued. That's why it's going to cause inflation to continue to go to the upside. And so the markets, however, reacted very well. And we even saw the debt market start to react very well as well. We, in fact, saw the 10-year yield drop very significantly. I wouldn't be surprised if we hit 1.99 as a yield. That's the move to the downside. And that's very, very significant. A total 180-degree turn and move. And it's just as extreme to the downside as it was to the upside. Now, this is a major concern, because for now, the markets are euphoric. moving to the upside. We are seeing a little bit of selling in there, so it does swing to the red a little bit before it moves back up to the green. But overall, a very significant upside move this past week. And will it continue this coming week? Very possibly. I mean, tonight the markets are showing a little bit of negative pressure, but ever so slight. It is still early in the evening trading session here. So we'll see what overnight markets do, as institutional buying and trading usually is happening overnight and in the early morning especially. But as I mentioned last week, there are two main scenarios that we have to focus on as possible outcomes here, especially in the short term. Number one, we can expect that markets will continue to be euphoric for the short term. They're going to go very strong to the upside. But once we have numbers start to come in, the reality will start to set in again, and the markets will slowly start to pull back down. I don't think it'll be quite as aggressive as we saw with the market spiking. And again, that's just artificially being propped up by the global feds or the global central banks. The second option, which is the one I think is less likely, but is still very much a possibility, that is, markets continue to remain euphoric, very aggressive to the upside, move to all-time highs, which wouldn't shock me. And then the reality of inflation comes back, recessions remain, and the markets absolutely collapse right back down to where we are today. So I'm not sure if we're necessarily going to hit all-time highs, but I do believe that we are going to see a little bit more upside here as the markets are continue to be propped up artificially by central banks. So what do I expect this week? Well, I'm going to say, because I'm leaning more towards that first possibility here, we may see a little bit of upside. I think we might also see a little bit of pressure here as the markets start to sit back into reality, because the truth of the matter is we do have more CPI numbers coming down the pipeline. And when we see them and we see that inflation hasn't moved and very possibly went back up, markets will pull right back down. Now, we are hearing just this past week, I believe it was yesterday or the day before, Friday or the day before, that a 50 basis point increase might be possibly the next step, even though 75 basis points are not off the table. The commentary was very, very dovish, which is very positive for those of you that don't know what that means. But I'm going to say this. The economies are in free fall. Recession is certainly still there, and we're probably going to continue to head that way. Inflation is going to continue to move to the upside, so much so that some people are saying we may actually experience an inflationary depression. I'm not sure if we'll get there. So, some are convinced we are well on the way. I do believe that we are going to experience a very rough recession. And I really hope we don't see a depression, but we will continue to see a devaluation of currency. And jumping on that point, just an interesting note this morning, the G7 has decided to ban new Russian gold, period. Now, some of you may think that that's going to cause gold prices to spike. I'm going to say probably not, maybe in the early trading sessions for a few days. But the truth of the matter, it's really not going to make an impact too much because most of the G7 doesn't buy gold anyways. But an interesting point is that the entire Eastern Bloc, and so I'm going to say basically everything east of Germany, does buy gold. In fact, they have been major purchasers of gold for the last 10 to 15 years, if not longer, which is indicative of where they think and what their actions might be as far as the US dollar being a continual and continuous reserve currency. They are starting to prop up their dollars and back their global economies, using gold. So it is interesting. Not sure it's going to impact or hurt Russia very much. I think it's more of a show, especially considering, as I said, the G7 doesn't buy gold anyways. In fact, Canada has zero or close to zero. I believe Trudeau sold that in his first term, sold the rest of our remaining gold stores. But anyways, that just kind of tied in a little bit there. I know it was a little bit off, but it tied in a little bit to the currency devaluation and what that could mean down the road as far as a division between the Eastern and Western blocks and currency as far as that's concerned. And we know that digital currency is on the way. There is no way to avoid it at this point, regardless of what our wonderful conservative politicians are saying or trying to fight for. The truth of the matter is the digitalization of currency is happening. It's just a matter of when. So, and that's going to be as a result of the devaluation of currency and fiat currency. Now, that being said, just to kind of wrap up here, I am way over the time I really wanted to spend on today's video. This coming week, probably going to see a little bit more positive, a little bit more mixed than last week where we ended up finishing almost every single day in the green, I think minus 1 or 2 days. We're going to see a very significant move, a not so significant necessarily move to the upside, but we will see some upside this week. I think next week we should start to see that calm down and we're going to see more red, not necessarily dipping back into the negative, but we will start to see far more red. Precious metals this evening, are moving to the upside in early trading. I anticipate in the morning that they'll probably be in the green as well. Recession is still coming. It is a busy week as far as reporting is concerned. Short week here in Canada. I will see you all tomorrow morning at the opening bell.